Hey everyone, John Henry here, Slingshot Futures Trading Group, SSFTG. In this video, we're going to be taking a look at the differences between an impulse POC, a developing POC, and a confirmed POC. I use these quite a bit, and I talk about them often, but I realized that there wasn't actually a video going over what the differences were, so let's fill that in really quickly here. So the first one is an impulse POC. The idea behind an impulse POC is, as the name would kind of explain, you're looking at the volume that happened during an impulse move. Now, an impulse move is typically a relatively strong parabolic move. It could be a string of solid bull or bear bars, or it could be some, really shallow corrective phases. Either way, it's a relatively strong unidirectional move up before there's been any pullback of substance. Now, let's look at Bank of America here, symbol BAC on a daily chart. This would be a really good example of what I would be talking about as an impulse POC. From the top all the way down to the bottom, the market just absolutely rifled straight down there. So this is where I would want to see, okay, as an impulse move, how did the market respond to it from the top down to the bottom? Where was the volume? Were traders getting in at the top? Were they buying in at the bottom? Were they stuck at the top? What all actually took place? And the reason I would consider this an impulse is because this went all the way down from top to bottom, but did end up rolling all the way up to a new high. That's important because, well, we'll talk about the other ones in a second here, but as an impulse is concerned, I'm measuring from the top to the bottom or the bottom to the top of a move. If I wanted to see, as an example, how strong traders were or where the majority of the volume was on the impulse move from the bottom to top, i.e. from here to here, that would be an impulse volume measure because really there hasn't been a whole lot of pullback. Realistically, we're probably going to see a POC back here because the market spent a majority of time. So if you want the true impulse POC, you'd probably be measuring from here up just to see where the actual volume took place. But either way, if we start from the bottom and go all the way up to just the top, and we can see, of course, as expected, the POC is down where the market spent the majority of its time. Now, again, we kind of expected that to be the case. So if we narrow this in a little bit to this lowest point before the market really broke out, right there, then we can see that the impulse from when the market really started screaming, the majority of the volume was traded here. Now, that could be useful for a lot of different ways. I don't really trade Bank of America too much, but maybe those are shorts who are stuck, who are looking to get out. Maybe they're new longs, and we haven't seen them exit their positions. Either way, that would be an impulse POC from the bottom to top or top to bottom. All right, so let's swing into a slightly different time frame here. Now we're looking at the NASDAQ on a 1-minute chart. Very close, very zoomed in. And what we're going to be looking at next are developing POCs. Now, developing POCs, you have to have a little bit of pre-context coming into it. You have to have an assumption. So what I mean by that is, an example, the market is going down here. So while the market is driving down, the impulse POC would then be drawn from the top to the bottom, right? See, how did the market respond on the way down? A developing POC would be starting from when that base was put in with the mindset that I am a seller, right? Then I am measuring from the bottom to whenever the market breaks back down to a new low again. That would be the developing POC and a non-confirmed POC because it's still working around. It could easily adjust and change from where it is. As an example, if we start from the bottom and move up to just this initial impulse here, the POC started right back here at around 14,734. If we continue it up a little bit further, now we've got a POC a little bit further up, 14,750. Then we continue it with a little bit further, and now we can see it move down here to 14,751. That's a developing POC. I don't know where this POC is going to land yet, but it can be useful in terms of how the market wants to move around it. As an example, if we draw this a little bit further forward, you'll notice that before the market really started tanking to the downside, it wasn't before it gave up its developing POC hovering in the middle. Now, would you have known that was the case at the time? No, of course not. It's a developing POC. That's the whole mentality. But if you're seeing price action showing and demonstrating that it is starting to sustain movement to the downside underneath it, and the POC is not moving a whole lot and you're getting continued pullbacks, as an example, if we draw this a little bit further forward, we can see that the POC has not changed. That's usually a good clue that it's becoming more defined and potentially will become, well, a confirmed POC. Now, confirmed POCs are the next one, and the confirmed POC doesn't happen until the market, again, backing up for a second, with the assumption that it's a downside. So a confirmed POC then would be confirmed once the market makes a new low. So if we drag this all the way back over to when the market actually broke down to a new low, the confirmed POC of the entirety of the move finally ended up back at 14,750. Now, is 14,750 going to be a do or die line in the sand later on? It might or might not be. It might be a nice zone for a scalp. It might have nothing happen there. But that is a confirmed POC. It takes that long. You've got to wait for the full completion to roll all the way back to actually confirm. So as far as the confirmed versus developing versus impulse, they all have their uses. They all have their different little quirks, their different little nuances. What I like using volume predominantly for, and I talk about this all the time, is that volume is a tool to analyze an overall story. If I'm expecting bears to come in, how are the POCs and the volume demonstrating it from the perspective of bears? Is it showing me that maybe it's not bears? Maybe I'm wrong on that analysis and I need to switch gears. So if I were looking at this as an example from the scope of a bull lens, then realistically the high is up here and we haven't gone all the way back up, right? We haven't broken to a new high. So if I wanted to, technically, I could start way over here and measure this as a developing POC, assuming I have the mindset that it will eventually break above this high. Now, if we zoom out a little bit, we can see there might be other contexts and other things going on. Like over here is a great example of why traders will do that. The market made a new low, and it ground around, and then eventually, if they were maintaining the mindset of the bears, it did actually roll down to a new low and became a confirmed POC. So if we measure during that period of time, obviously the POC is going to be jumping all over the place inside of here because it spent a ton of time in there. First, it was a little bit further up here. It actually stayed there for a while. Let's draw this a little further forward. It stayed put. Continues. Stayed put. Wow, very interesting. It actually didn't move around a whole lot. This makes it a little bit easier. The market continues a little bit further up. We drive it back. We continue. Ooh, did it change right there? Or did it just get a little thicker? I think it just got a little bit thicker. It's probably in about the same spot. And it wasn't confirmed until we finally broke down to a new low. And that confirmed POC, interestingly enough, actually was the same one throughout the entire thing. But as it stands, then it became a confirmed POC, but only after it broke that new low. So the entire time it was still developing up until that point. And if I'm trying to figure out where the bulls are winning and where the sellers are losing their grip, that's where the developing really comes into play. Because I can't realistically be a short if I'm above volume, right? If I don't have volume supporting my move or my case, then I can't be a short. And if you're looking at this from a developing short standpoint and we're dragging this further forward and further forward, we can see the sellers had their shot, but as soon as it started rolling up, every time it dipped back there, we start seeing a little bit of responsiveness. That could be those sellers starting to exit at break evens. Then the market begins rolling back up to new highs, and until we get back underneath that POC, I can't expect the sellers to take over. And here again, right before the big move down, they usually have a nice little jostle around the POC, and they continue with the finalized move. So that's the difference between impulses, developed, and confirmed. The real thing here that I'm trying to do between all of them is, what is it helping with in the terms of the story? Is it telling me what the bulls are doing? Is it telling me what the bears are doing? Where the bulls are stuck or where the bears are stuck? It gives a huge insight in terms of the bigger picture, the kind of backbone, the reason why the market is doing what it's doing at any given moment. So hopefully that's helpful in clarifying what I'm talking about between the different types of POCs. I know when we're in the heat of the moment and the market is jumping all over the place, it can be very confusing throwing different words around if you don't know what they mean. So hopefully this helps clarify that. Of course, if you do have any questions, make sure to throw them in the comments below, or if you need a more detailed question answered, feel free to shoot me an email, jhb@ssftg.com. I hope you have a great rest of your day. Enjoy, and we will see you all in the next one. Thanks.